I know there's only a couple of us here, but we'll make it we'll make it beneficial. Welcome, Christmas edition, last webinar of the year here, I think. As always, please, questions are always welcome. This is probably my most general webinar that we've put together. I think the subject matter here was just basically we're going to run through a whole bunch of analysis and kind of see what it kicks out at us at the end of it. And it is a very interesting environment that we're living in. Sorry if my voice sounds a little hoarse here. It's freezing in North America at the moment, and I'm just not a big fan of the cold. So we're going to run through some things. I think I want to start off with just a basic general fundamental look at stuff on the broader term, and then we'll circle back to the technical stuff, because we've got to sort of try and marry this up a little bit, don't we? I was just reading a headline. There's rumors now that they're gonna postpone the Tuesday Brexit vote, which it leaves more of a mess if that's indeed the case. I mean, I didn't think that she being Theresa May was necessarily going to win or get her deal through Parliament, but we'll see. Brexit's interesting, isn't it? Because here's my thinking. We might as well start there. Here's my thinking on this. Is how much more bad news can we get? I mean, I don't think anybody expects that this plan will go through Parliament. All right? The pound has been hit with nothing but bad news. The Bank of England has said that if there is a no-deal hard Brexit, that they expect the economy to shrink by as much as 8%, which I think is probably dramatic. But a headline like that is in of itself a big deal, isn't it? So my point being this is, what could possibly be said that the pound has not heard? It's been beat with an ugly stick on every front possible, hasn't it? So I guess what I'm saying is, any semblance of good news, and I think it's going to really get busy to the upside. Now, that said, the technicals don't agree with me yet at all. But we'll circle back to the pound in more detail. Let's talk about the quagmire that is the fundamental situation. All right, so in the US, we have what they consider full employment. All right, now that's hard to determine because, as you know, in the United States, you're only considered unemployed if you're seeking unemployment benefits. All right, now there's been very little wage growth, if any at all, over the last even 10 years. All right, salaries really haven't gone up. However, if you go to the supermarket, you're getting less and less for your money, despite what the government's telling you. So CPI, they take out, for the CPI information, they take out energy costs and food costs. For PCE, they include those. All right, so I think that PCE is probably a slightly more accurate measure of what's going on. PCE, we're talking about it being 2.5. The Fed funds rate is 2.25. I think that the December rate hike is on. However, then it's in jeopardy moving forward. I could see 1 or 2 next year. And a lot of this is also political because Trump is pretty good at firing people. It's basically what he does best. Nobody wants to work for him. And I think that Powell is in the same sort of spot. Although the Federal Reserve is meant to be a sovereign entity, they're meant to be immune or rather detached from any political influence. It's just they're just unequivocally not. All right, so there's this perception that stock market health in the United States is everything to do with economic health, even though even though the wealth effect hasn't been massively successful, has it? A bunch of old guys that were invested in the stock market for the last 20 years hung out in 2008. Now they're loving this upside while they retire. But people that lost their homes and then no disposable income to invest have only recently got in the market and seen it all evaporate. So there's this perception that the stock market has everything to do with their political success. We know that's not true. So I'm kind of playing both sides of the political fence there because I don't really care about that stuff. On the other hand, we don't have any wage inflation, but we kind of have this drift in price inflation. But in the other token, we've got oil on its face. And while we have oil on its face, and I realize that there's some merit to buying it here around between sort of 48 and 50, looking for, I don't know, 10 bucks on the upside, 58 to 60. I don't think it's going anywhere because if you guys followed the OPEC, and I'm jumping around and I want to make a bunch of predictions today basically, but we need to cover the thinking. Let me mute that. The thinking's as important as anything else. So we need to get the thinking down, and then we can kind of move from there. And I'm just talking as I would think it through in my own head. Now, the thing with oil is there's a lot of analysts calling for a bunch of upside, but you've got to remember that oil's priced in dollars. And it's a little bit the same with the metals. I feel like there would have been a lot more metal demand if the dollar had been weak, but the dollar's been pretty strong. I mean, yeah, the Aussies kind of read a little bit and come off it, and the Euros hung out at that 113, 114 mark, but the dollar's been relatively strong. And then, it's very difficult for oil to rally sustainably while the dollar is what it is. Okay, so let's talk about oil for a minute because it is fundamental to inflation at the moment. All right, now, OPEC had their meeting last week, Thursday, Friday, and they agreed to an 800,000 barrel a day cut for voting members and 400 for non. All right, but here's the thing about oil. Is while OPEC is supposed to be the central sort of distributor / manager of all oil globally, the US is now a 3.2 million barrel a day net exporter of oil, which is a first, and that's because of fracking. Turns out we've become extremely good at pulling oil out the ground. All right, now frackers, for those of you that, fracking is a hydraulic mechanism, all right, frackers they literally call their buddies and say, hey, we need to go to work when oil is above 47. They say 43, but I've seen it sort of more around 47. All right, I'm totally discombobulated. The drillers take several months to bring wells online. All right, frackers, literally 24 hours. So your buddies go home, they hang out at the house, you're like, hey, oil's come up to where we're profitable, you call your mates, they fly in, and all of a sudden you're fracking oil out the ground. So any lag that you've had in supply gets caught up very, very quickly. This is why we're seeing these rallies into the 60s and 70s, and all of a sudden oil inventories explode. Because what's happening is we're bringing on, I say we because it's principally the United States, because it turns out we don't care about the environment anymore. We bring on our hydraulic we bring on our fracking, and it just pumps the world full of supply and it drops off. But the problem with OPEC is all these drillers want no part of reducing their supply because a couple of things. One, their economies rely on it. Two, they're worried about market share. All right, if you need to drink 10 bottles of orange juice a day, all right, and Susie has forever sold you 7 bottles of orange juice every day, and Johnny has sold you 3, and all of a sudden the management of orange juice comes on and says, Susie, you can only now supply 4, and Johnny, he keeps it at 3. Inevitably, you're going to go and get your orange juice from somebody else. And the thing is, when they allow Susie to then give you back your 7 bottles a day down the line, chances are your secondary source that you found is going to hang on to that market share. You're not even going to bother to go back to you had. And this is the big concern with oil producers, is that they're not able to recover the market share that they potentially lost. So they have no interest in actually cutting supply. They'd prefer to produce cheap oil than no oil. All right, so I don't think oil's going anywhere, which in turn means that oil is sort of artificially squashed. And yes, I think it'll oscillate between sort of the late 40s and early 50s, but I don't think it's going anywhere. All right, so that puts the Fed in a weird spot, meaning that puts the Fed in a spot where I don't think they can move a lot on rates. Okay, the other thing to think about is that we have this little rate inversion, which tells me that people have been buying the 10 a lot, because what that does is drive rates down. In turn, we get this little inversion of interest rates. Now, there's generally speaking an 11-month lag between an interest rate inversion and when a recession typically hits. All right, so if we, December now, next year, September, October is going to be interesting, which actually kind of fits in with what I'm thinking. Okay, so in other words, all of this said, I expect a December hike and then maybe one more next year, and if things pick up, maybe 2. But I don't expect 3 like people have been talking about. All right, now, you've got to remember that currencies are traded relative to another one. So if we're saying, hey, the dollar, the Fed's going to slow down, that's dollar negative in its assumption. Oil staying relatively flat it's dollar negative in that the inflation push isn't necessarily there. Okay, so let's assume that the dollar remains flat to borderline weak for next year given the movement of interest rates. So then our next question is, traded relative to what? Something stronger? So what is that? The Australians, they got a little bit of a housing bubble and potentially a slight slowdown from China if the trade war thing really escalates. All right, now I do fancy Aussie, anything below 71 I think is a buying opportunity, but particularly into the late 60s. If you said to me in 24 months, where do I expect Aussie to be, and did it look like a bargain at 68, 69 cents, I would say absolutely, as a tentative plan, 70 cents up to sort of 85 would look pretty good. All right, but let's take a peek at the pound. And we'll make it brief because we supposed to have this Brexit vote Tuesday, but they're talking about a little delay in that. I think it's worth mentioning that I don't think I've seen it quite this complicated in a while on a fundamental and technical basis, for that matter. It's very, 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 if you're a swing position trader, this is as complicated as it gets fundamentally. It really is. I mean, it's just so many external forces all over the place. It's not just a rollover in central banking policy. So we're going to have to fight for our money in 2019, I think. There's going to be plenty of trading opportunities, but if you're somebody who likes to sort of buy a currency and then go and bake a cake, it's going to be difficult. Anyway, so let's look at the pound. And stick with me. I want to try and cover, we're already 20 minutes in now, I want to try and cover as much as we can. Maybe we can buzz through like 5 or 6 things. Let me find a cleaner chart for you here. Okay. You guys have seen this before a little bit. This is way out to monthly. And here is what I've been looking at. Okay. Let me get a different color pencil here. Yellow will work. Will it? No. Blue. All right, so this is a range on the pound between 93 and all the way out to 2003. All right, then price breaks above it and hangs out for, I don't know, a 5-6 year period. All right, then it slips back into that range between that 171 and 135 mark, and has now been living outside that range for the better part of 3.5, 4 years. Okay, so we kind of have this protracted period here where the pound loves to live between, call it 140 and 170, and it's gone back there. All right, and if anything, the US market and the UK market, they are pretty tethered to each other. They really are. All right, so it's my expectation. There's a lot of people calling for this on the pound. I've seen a ton of analysis to this effect. And I can see why, because, this is not essentially, it is a downtrend. All right. We've seen nothing but these lower highs, lower high, lower high, lower high, potentially another lower high, and then a push down towards 115. I don't subscribe to that. I don't. I mean, I can see the merits of it on a purely technical basis. It completely makes sense that that would be the case. This. No question. Up to 135 and then all the way down to 120. All right. Now, I like to, for my longer term swing trades, I like to think about the question again. Is there value in the, if somebody said, where do I think the pound will be in 2 years? I think we're going to be closer to sort of 145, 150 maybe. All right, so would 126 represent good value in that? Yes. Could it go to the late teens? Yes. Do I want to be 1,000 pips out of position to make 3,000? Unequivocally not. All right, so we've got to get a little bit more detailed than that. All right, now going to weekly. This zone here between that 120, this is the bottom, this is sort of the end of the initial shock of, hey, we now into this whole Brexit thing. All right, you've got to remember that nothing's ever as bad as it seems and nothing's ever as good as it seems. So even if there's a cataclysmic event like this, all right, people wake up the next day or a couple days later and they go to work and they keep living their lives of quiet desperation, and they realize that all the buildings are still there and everybody's still got their jobs, and a little bit of confidence returns just by virtue of routine and nothing's actually materially changed. All right, so I think that this zone represents great support for the pound. All right, and on the shorter basis, we've reestablished a little downtrend by virtue of making lower lows and lower highs, no question about it. All right, and I think that what we're doing is we're pushing down into this mid 120 zone. All right, and there's clearly resistance here at 130.50 area. You can see all the hesitation through here that we had it for months. I mean, these are weekly candles, so you know that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 4 months worth of just hanging out in the early 130 range. Okay, so I think it's fair to say that we're going to bounce here in the late one or mid 120s, return towards that 131 area, and then go right back to where it came from. All right, so, oops, didn't mean to clear the pen there. So this is pretty big because this is going to include the full Brexit vote. Now, pound's very weak today. And we don't want to appropriate, we're looking on a long-term basis here. I don't want to appropriate, prediction based on one day. So it takes a lot of guts to look past that, and a lot of fortitude. takes a lot of fortitude to kind of look past that. Sorry, I was reading there's more, I was reading BBC World here on Twitter, and the Theresa May stuff's coming down as we're talking about it. Anyway. So I think that we're going to do sort of a 124, 125 thing here, up to 132, and then push all the way back down to where it came from. And this is on more of a technical, not a fundamental basis. And you know, that seems reasonable considering all of this resistance and the top of this. And if we grab a fib, I guarantee if we grab a fib of this swing here, that's probably around, you know, 30%, maybe 382. We can do that, you know, potentially if we're going to drop here into the middle of that zone. I like to do this too, by the way, is project where I think price is going so that then I can pull the fib relative to where that is, and that'll give me a pretty good idea as to where I expect the bounce to be if I'm a bull. All right, so you know, in this case, that puts us right into the heart of sort of the 382 to 50%, and then a push back down there. So I think towards the end of this week, we'll be able to buy this around 124, take it up towards 132, and then I guess if you're a bear, you would just wait for that trade, and if you're a bull, you would let it drop all the way back down and then buy it again. All right, and on the longer term basis here for the pound, I'll scoot this over a fraction so we can just draw more information. So that's my near term trade. My medium term trade would be a 124, 123.50 trade up to 132.5, because I am a pound bull, obviously circumspect because of the amount of news going around. And I actually think the delay in the vote's actually not good for the pound. It's not great because the market, it's just uncertainty, isn't it? People just want to move on, be done with this. Good deal, bad deal, they just want to be done. Enough. Anyway, so medium term trade would be that 23.5, 24 up to 32.5. But then into next year, you know, that's probably going to take us, this is a weekly here, so that's probably going to take us really very close to sort of April, May, I would think, all of that. And then I expect us to find a bottom, but that's going to take a long time, maybe into this time next year, and then pound moves its way up to 145. So really, early 120s, I'm just going to put 120 here in little asterisks. Those are little asterisks. And then a 145 target, maybe even higher on the long term. And obviously there's a ton of trading in between and doing the things, but in the broader sense, that's what I'm looking for on pound. And that's bucking the trend a little bit because I've seen so many analysts calling for the early, like the 110, 115. I just don't see it. I think that the dollar is going to get a little weaker. The Fed's going to guide down. You know, it's tough because the pound by itself isn't exactly rampantly bullish, is it? You know, every long-term technical chart's saying down, but I'm sort of not. All right, if you have any remarks or questions, fire away. All right, so that is my tentative short-term or medium-term and longer-term play on this. All right, now, let's get rid of that. I want to talk about the S&P. Let me drag a different chart across this one. Something a little messed up with that error there, charting error. Okay, so the reason I'm bringing this up is this. You can see my pivots here. I got the yens on the bottom. Notice this, and this is just something you need to think about in terms of when you're looking at relative strength or weakness on a currency. Notice this fairly dramatic move on this is USD yen on the bottom. All right, and notice the very small move on the S&P here today. right? Very small. I mean, in points terms, it's quite a lot. It's bounced, 30 points. But in terms of the overall move, it's a tiny little bounce. My point here is simply this very small movement in the S&P brings about a fairly dramatic upside bounce in the USD yen. So we're getting an exaggerated upside move in the yen relative to what we're seeing in the S&P. And that tells me that the yen, USD yen, or rather the yen crosses, can rally on even a flat stock market. And I think it's because it's a process of elimination. Where would you want to put your assets? Metals are tough because of the dollar strength, but I still think there's some value there. Euro, there's a lot of uncertainty, but, it's relatively strong. Pound, we've talked about. The bond market has been purchased, right in that 3% on the 10. And the stock market's got its issues. So I think the yen, the carry trade becomes very attractive again. All right, so the thing is, though, we do have to monitor the S&P because the yen is obviously still correlated, even less so, but it is correlated to the stock market. All right, so in other words, I want to get into the yen crosses on a sustainable carry trade basis, but we need to think about the stock market first, and then we can kind of cross-correlate that back to the yen crosses. And obviously, you got to think about what the quote currency is doing as well. This is the thing about currencies, it's all about relative strength. You have to project the relative strength in your mind forward to be able to know what to trade relative to another one, and that's something that few people seem to talk about, and it's already the crux of the operation. All right, so here's our S&P chart. Lots of monthly stochastic divergence. Okay, now here's the weekly. It's down, guys. Let's pull a fib of this last swing. I'm sure that some people will be looking at that. I think that's the most natural one to take it to because of these multiple bottoms. You can take it here, it makes no difference. If you take it to that swing, the 50% happens to be exactly 2,500. If you take it down here, then 2376 is 50, 2509 is a 382. I don't think it makes any difference. I think we're talking about the same thing. We're talking about sort of this zone. All right, and I expect little something like this. That stuff doesn't just roll over here. Cheap money is still the mechanism, isn't it? And has that mechanism changed? No, it hasn't. They're raising rates, but it's slower than pond water. So really, the cheap money mechanism is still in place. All right, I always said that the stock market's really going to drop when money becomes so expensive that the buybacks stop and companies actually have to make money to survive. They can't just borrow it cheap, buy back their stock, drive their price up, leverage that in bond market, blah, blah, blah. All right, a hell of a business model. Just issue bonds and let the government buy them. Flush a company full of money courtesy of government debt. It's unbelievable. Anyway. And then pay yourself on that basis. All right, so I think we're doing sort of something like this on the stock market. And then we're going to probably push up into the 130s, develop a top, and come down and settle around 2000. I can't wait for this. I mean, the panic is going to be unbelievable. And all that that's doing is pulling back the main trend, isn't it? Okay, so, on the stock market, I think that we're going to go back into the mid to late 27s, push down towards 2460, all the way up to about 3250, and then you see about 1,000-point drop to, like, we'll call it 2200. And then I think we range around there for several years, between sort of call it 1800 and 2400 years. All right, so on the shorter term, you know, these are even valid trades, I think. Short S&P between 27.5 and 28.10, take it down to 24.60. That's a huge trade. That's a better part of, what, a 300-point drop. All right, at which point I do think it rallies up towards 32.50. People will think everything's good. All right, and the market starts to falter. The Fed comes in and says we need another round of quantitative easing. Only this time it does nothing for the market. It actually does the opposite. That crunches the dollar, and the stock market slips towards 2200. Metals rally. All right, that's 4 years worth there, guys. Okay, and all that's happening is, you know, all that's happening is it's bouncing off the fib of this major, it's bouncing off the fib of this swing, major swing, going up, making a slightly higher high. That sort of collects a trend line at the top here. It makes it, you know, if this was a 50-minute chart, you wouldn't think anything of it, right? And that takes several weeks to top out, and we slide down towards a pullback of the major trend of this, and then a consolidation. Completely normal, but because it's on a much longer time frame, it's going to look crazy, isn't it? And there's going to be fundamental things involved and all this other stuff. Now, the reason I'm bringing this up is maybe some of you actually want to make money on the industry. I think the S&P is probably the most tradable thing going at the moment. Pound's just getting clobbered. All right. The reason I'm bringing this up is because I think that this rise here represents a very significant opportunity on the yen crosses. All right, let's get rid of this a minute. I'm going to cover euro very quickly because I want to look at euro yen. You know, I think that's something like this for euros on the cards. Once again, lots of range support. That's always great support. It's spongy though, because look at that. Spongy meaning that it's a large support range, you know, because look at this price action in here. Okay, so, you know, I'm all about buying the euro around 110, 111 and trying to take that sucker up towards better part of 116. You know, on the shorter term basis, something like this. Here's a 4 hour. I'm jumping through it because I got 7 minutes and I'm trying to bang out as much as I can yet, you know, something like this. And that's based on the pullback of this drop. Resistance, 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 resistance. It's all over, isn't it? 115 psych level, you know, so 115, 115 and a half takes us down towards 112 and then we really rally. Both very tradable things. You know, I really think you can short here with some confidence. 115, we'll call it 115.20. Looking for a 112 target and then just flip the position for 1,000 or 500 pips, excuse me. We'll call it a, you know, let's call it 116 target for, to be conservative. You know, so there's 300 down, 400 up. And I'm pretty neutral on euro fundamentals. I think that this is the one pair you probably can trade both ways. Now, I would look at this as a little bit of dollar strength based on a, you know, we'll call it 2760 for 2460 move S&P. I think that that'll constitute that drop. Okay, and then we can look at buying that up as the stock market recovers or at least flattens. I hope you guys can kind of see how I'm trying to build the case here. It's difficult. The timing's difficult because the fundamentals are hard. The stock market's hard. There's so much going on we've never seen before. This isn't just basic stuff here anymore. Like, it really is. You know, there's the oil influence, there's the Fed, there's a lot of components And yes, there's going to be interim trading opportunities, but I think there's going to be some good stuff here. It's just more than ever, not buying in the middle of stuff is going to be, or selling is going to be critical. You've got to buy at the extremes of the market. I hope that makes some sense. Some of you are probably saying, I don't know what an extreme of the market is, Pegler. You know, at least buying like well-known, easy to identify support and resistance zones that at least gives you some security irrespective of the near-term fundamentals. All right, so let's scoot over to the Euro Yen. And the reason why I think that this is going to be nice is because even though we've seen that, you know, sharp pullback in the stock market, Euro Yen's kind of created this flag, the weekly chart. If I grab a fib here of this rise, the 50%'s 124. Admittedly, it's been in, you know, the stuff that's impervious to the stock market dropping should tell you something about its relative strength. So I actually think that this is looking at something along these lines. The euro drops towards 112. This pushes down into the early 120s. And then we see kind of something like that. You know, if I grab a, if I grab here, I like fibs just, I don't even really draw them for myself. I'm just drawing them more for the benefit of identifying what we're looking at. You know, if I take it all the way to the bottom, the 50%'s at 123 level, which is not insignificant because of this. It's further support. I always like to have multiple overlapping magisteria in terms of support here. You know, if you go back here, it's not insignificant. Not insignificant. Not insignificant. And remember that you don't, I like to just place levels here by options, but you can boil it down to get to these zones and boil it down and start looking in hourly and look for changes and look for basing of things, etc. But I like to, I like to just put orders in and live with it. The less psychological management, the better. Pound is just getting beaten with an ugly stick. I think that delaying that vote really has sort of, there's a lot of, okay, so now they're talking about, going back to the Europeans and asking for a different Brexit deal. Here we go. I mean, we're living in the twilight zone here, folks. I mean, nationalism was cool in the 80s. It's not so boss in 2018. Anyway. Euro yen. So what I would love to see is sort of something like this, as that euro comes from the 115, 116 zone down towards 112. That takes the euro yen hypothetically down towards 122. And then we look to buy this off this large support area all the way back up here. And this is the same for all the yens. All right, so I think early 120s up to 142, there's 2,000 pips. I think this is our best trade of early 2019. We can look to do the same sort of thing on pound yen, but I would prefer Aussie yen as well. I don't know if you guys agree with that. And I don't really fancy, I know it's a lot of pips, I don't really fancy getting involved in this zone. It's ugly. On a swing trading basis, I know some of you do have no interest in swing trading. But a piece of advice, if I may, even if you are spot trading on a 1 minute basis, trade with the fundamental bias of the longer term. You'll be much happier. Because if you go against your bias and you get trapped in something that you don't like, it's very difficult to manage that on a psychological basis. Because then you're like, oh, I want it to be long, but now I'm short and I'm losing money, but I want it to be long. Then you're not only losing money on the trade you didn't want to be in, but you've also lost opportunity profit by being in the wrong side of what you didn't want to be in the first place. But because you think trading makes, I've got to be trading to make money. No, you got to be in the right stuff to make money. All right, so tentatively, a 121.50, 122 euro yen long looking for 142, 145. There's 2,000 pips. And I think that'll materialize somewhere around February, March. And we'll watch it in future webinars, and you guys can tweet me or tweet me or whatever at ForexDavid, ForexDavid. I'm always available there. Or c5davidpegler@yahoo.com on the emails. Let me quickly scoot over to Aussie Yen because I think it's the same sort of thing, and we'll wrap this up. I've run out of time today, but maybe we can, if you guys need to reach me, by all means. And I think that Aussie Yen's the same sort of thing. We can just play this range. We're right in the middle of the range at the moment. That's 90 on the top, 72 on the bottom. I think this is very, very longable at, I drew this here at 83. I don't. I think that's more up towards 84.5 like this. But I think this is very longable around 71. Looking for around 92. Okay, 2,000 pips. I truly believe that these yen crosses anywhere around, and it's going to be more about a stock market timing mechanism rather than the cross itself. So in other words, when that S&P pushes down into the mid 24s, late 24s, 2460, 2480, somewhere in that zone, then I think we can start to look at the yen crosses irrespective of where they are. All right, so let's say we're at 67, 68 on Aussie yen. I'm all about it. If we happen to be 119 or 120 on the euro yen, great, even better. Then I think you're looking at a couple thousand pips upside each on those. Does that make sense? I hope so. All right, guys, I know we jumped around and we went long term here, and that doesn't suit a lot of people, but it's important. I firmly believe, even if you're trading short term, you've got to have an idea the longer term direction. I've seen so many remarks on things lately where people are like, oh, why do we use a 4 hour? Why do we use it daily if I'm trading off the 1 minute? The market fractals are just so important to conceptualizing which way things are going to go. All right, so I hope you enjoyed this. I hope you got something from it. Please reach out to me. For no other reason, just to cross information at ForexDavid, ForexDavid. All right, and we'll see you guys soon. Thanks.